also look at the video. I'm also recording this session so that those who will join late and also those who have problems with their network can also be able to watch it at their free time or at a later time. Now, to start with our first item, now a business can be defined as an integrated set of activities, that is the inputs and the processes, and the assets with the purpose of providing a return. Now, the return may be in form of dividends. It may also be in form of lower costs of production or any other benefits. So that is just a definition of a business. Now, when we move to the business combination, this refers to a transaction or other event in which one corporate entity, which we can call as the acquirer, obtains control of one or more operating businesses. Obtains control of one or more businesses. So they may do that through the mergers. Now, a merger is an arrangement where two or more businesses are coming together to form another company. Now, in some instances, you will find that these two or more businesses may sometimes lose their identities. So they may come up with a new name. Or in certain circumstances, they may also have got their same names, but now the two will be combined together. A good example is the ICEA and the Lion Group, the insurance companies. When they merged together, they formed ICEA Lion Group. Then we have also an example of the Standard Bank from South Africa, which also merged with the CFC Bank in Kenya to come up with the CFC Stanbic Bank. So we can give more examples of that. But now in the mergers, you will find that the two or more companies may come together for a number of reasons, which we will look at. One of the reasons may be because of to control the market share and also to add on the capital base of the existing businesses. Now, the combination may also be in form of an acquisition. Now, when Company A is acquiring Company B, what it simply means is that A will be buying B. So again, in such an instant, again, the company that is being acquired, we call it the acquiree. We call it acquiree. Maybe I can note it there. Call it acquiree. You there. So the acquiree, sometimes it may lose its identity or it may also retain its identity. Now, because of the customer preferences, most of the companies that are being acquired, particularly even in Kenya, most of them usually do not lose their identities. they usually do not lose their identities. An example we can give of KCB Bank Group acquired National Bank, you still find that the banking halls at national banks, they have not changed their names. The names are still the same. Even the processes are still the same. It is only the ownership that changed. We also have an example of Brookside Dairies acquiring so many other Molo Milk, Daima Milk, but they have retained their names because of the customer specification and also customer preferences. Now, we have several reasons for business combinations. One of the reasons is because of the cost advantage. Then we have got the risk aspect to lower the risk. Then we also have the operating delays. We have avoidance of takeovers. When there is a takeover, it means that now one company will take control over even the management of the other. The other reason is for the acquisition of intangible assets. Then we also have the reason of diversification into a new market or a geographic region, when maybe you want a company outside Kenya wants to come in Kenya. The easiest way to penetrate the market is by maybe having a merger or acquiring an existing company. Then we also have the access to new customers, the products or the services, and even the expertise. So those are some of the reasons for business combinations. Then now a business combination may happen in two forms. We have got the friendly combination, and we also have unfriendly, which is also referred to as the hostile combination. Now, in a friendly business combination, the boards of directors of the potential combining companies, they negotiate mutually agreeable terms of the proposed combination. So they can negotiate on maybe the value of acquiring the assets. They can also negotiate on also the goodwill that is to be paid by the acquirer. And so that will be negotiated in a friendly acquisition. Now, for the hostile acquisition or combination, now the board of directors of the company targeted for acquisition always resist. They always resist the combination. Now, there are some of the defensive tactics that those boards can maybe apply to prevent now the hostile takeovers. The first tactic is known as the poison pill. The poison pill. This is a case where now the board may decide that they give stock rights to existing shareholders to purchase additional shares below the market value. Below the market value. And they will be doing this to encourage more of their existing companies to buy the shares in order to increase their capital base. Then we have the next tactic, which is the green mail. Now, in the green mail, you will find that now the board may decide to purchase their own shares that are held by the company that wants to acquire them at a price which is in excess of fair value. And this is just to entice their shareholders to release some of the shares to the board. Then we have number 3, which is the white knit. In the white knit, the board may encourage another company now to which is more acceptable to them to acquire or merge with them. Then we have number 4, which is selling the crown jewels. Now in this instant, now the board will be selling valuable assets to make the firm less attractive to the would-be acquirers. So they can sell maybe part of their properties that are highly valued to make the company less valuable. And then the last one is the Pacman defense. Pacman defense. This is attempting an unfriendly takeover of the would-be acquiring company. So they can also try to put in a bid to acquire the company that maybe wants to acquire them. So those are some of the tactics that the board may employ to prevent a hostile takeover. Now, our next item is that when there is a combination, you will find that a transaction or other event in which one corporate company, now the one that is acquiring the other one, obtains the control of one or more operating businesses. So the company that is acquiring the existing business will obtain the control of its operations. Now, when the combination occurs also, you will be expected that you report the consolidated financial statements of the combined financial position and the results of the operation. So we mean now the parent company. The parent company is now the company that is acquiring the other one, and the other one now will be the subsidiary. So the parent is the controlling company or the investor, and the subsidiary is the controlled company, which is also known as investee. Now, an investor controls the investee when the investor is exposed or has rights to variable returns from its involvement with the investee. So what we mean is that now when you buy a company, you have to get control of that company that you have bought. Now there are if you only have one company with a control, now that will be a case where now you are buying the subsidiary company. I want us to move to the next slide. Now, if maybe an investor owns more than 50% of the shares now, if you own more than 50% of shares, then you will gain control. Now, this control can be present also with less than 50% of the voting rights, because one, you can have the ability to elect the majority of the board, that is if you own more shares, and you can also have special voting arrangements also within the same company. Now, I want us to move to the next slide. Remember, I've said that my presentation will be short and then we have to watch a video. Now, we have forms of business combinations. The forms of business combination. Now, one company can obtain control over the net assets of another company by one, purchasing its net assets. Number two, you can also purchase the shares. And number three, you can have a contractual arrangement that this is simply an agreement to control the company without acquiring the shares. And you could also form a new company, issue shares to both the sets of the old shareholders, or buy the assets of both, now the old and the new. So that is an amalgamation. Now, the other forms of the business combination results in the assets and liabilities of the acquiree being combined with those of the acquirer. So those are some of the forms. Those are some of the forms that we can have in business combinations. Now, if we look at a case where you are buying the assets versus when you are buying the shares, then now when you buy the assets, you have to deal with the company itself. But when you are buying the shares, you have to deal with the shareholders, because now those assets are held by the shareholders. Now, the result in both the cases is that now when you are buying the assets or the liabilities are on the acquirer's books. And when you are investing in shares, then the result has an investment in shares on the acquirer's books also. So that is a similarity. Now, when you are reporting your financials, now when you are buying the assets, then you don't have a separate legal entity. You are using just the same entity with the company, and you are also not expected to prepare a consolidated financial statement. But when you are buying the shares, you must do the consolidated financial statements, and you must also have a separate legal entity. And we'll show that in our video. So we've looked at that. I think we can now look at the accounting for business combinations. Now, the accounting entries that are expected we can use maybe three methods. You can have the purchase method, the acquisition method, and the new entity method. So again, we will show that in the video. So that can be shown in the video, so we don't have to go through it. Now, we usually have the main principles when dealing with the business combinations. These principles are simply the steps that we can follow. Now, the first step is to identify the acquirer, the person who is buying the assets or the shares. Number two, you also have to determine the acquisition date. Number three, you have to calculate the fair value of the purchase. You calculate the fair value of the purchase consideration. Number four, you have to recognize and measure the identifiable assets and liabilities. By now, I hope we know the differences between the asset and the liabilities and their definition. And then lastly, you also have to recognize and measure the goodwill or gain on purchase. Now, the opposite for goodwill is gain on purchase, and again, we'll also show that in our video. So we have the summary, and that will also show, so we don't need to go through it. We have an example there. So before we look at this example, I want us to look at an external video that will help us to illustrate just to illustrate what we are talking about.
Dollars. Okay, so this video is going to cover the consolidation process, which is simply when you're looking to add the assets and liabilities of a subsidiary to the assets and liabilities of the parent company to make one consolidated group. So to start off with, we're going to look at how we actually record the acquisition of a company. We're going to do that through an example here. Ben Limited issues 10 shares to existing shareholders of Company B at $10 each to acquire the company. Effectively, what Ben Limited is doing is issuing 10 shares worth $10 each, so $100 of its own shares, existing shareholders of Company B, in exchange for the actual shares of Company B. So Ben Limited now owns Company B, and the old shareholders of Company B now own some of Ben Limited. The way we record this is we debit the investment in the subsidiary for Ben Limited. So UCO would get rid of the
Hello. I hope that we have learned something from our video. Now, what I want to do is maybe if anyone has anything need to clarify, you can ask, and then after that we will now go to our discussion forum, and also look at an example by applying what we have seen from the video there. So if there is any question, you are free to ask. You can unmute your microphone, or you can also send it through the public chat. So if there is a question, please, the time is can ask before we move to our discussion forum and also look at an example there. Seeing Koech, Lagat,